Hey everyone, welcome to The Explainer. Today we're tearing into the fascinating financial story of Primoris Services. This is one of those companies that has quietly generated just mind-boggling long-term wealth, totally flying under the radar for most everyday investors while steadily building an absolute empire. If you've ever wondered how stealthy market compounders actually operate, well, today we're opening the books to see exactly how they did it.
2,719%. I mean, just let that sink in for a second. That is the staggering 20-year return for PRIM stock. If you had parked your money here 2 decades ago, your portfolio would have completely transformed. But to understand exactly how they achieved this monumental growth, and honestly more importantly, to figure out if it's still a good buy today, we need to look under the hood of the raw data and perform a thorough financial autopsy.
To do that, we're going to follow this roadmap. We'll start with decades of massive returns, dig into the revenue growth engine, check out efficiency and profit margins, ask, is the price too high, and wrap up with dividends and financial health.
All right, let's jump right into part 1, decades of massive returns, the prime hype. It's incredible how consistently Primoris has rewarded long-term investors across multiple decades. We are talking about a 15-year return of nearly 1,600%, a 10-year return approaching 700%, and a massive 3-year return of over 577%. This isn't some flash-in-the-pan meme stock, right? This is a relentless compounding machine.
But here's the crazy part. The hype has really gone into overdrive lately. The stock delivered a massive 131% return in the year 2024 alone. I mean, for an established company to double its investors' money in a single calendar year tells us something highly unusual and highly lucrative is happening beneath the surface.
So, what exactly is driving that? That brings us to part 2, the revenue growth engine, fueling the rise.
When you break down the metrics, top-line revenue has been growing pretty steadily at around 16 to 19% annually over the last 3 to 5 years. But their free cash flow, it has absolutely exploded with a 217% 3-year compound annual growth rate. They aren't just growing their sales, they are becoming exponentially better at turning those sales into cold, hard cash.
And to give you a sense of scale, this explosive cash flow growth is powered by a trailing 12-month revenue base of over $7.5 billion. Moving the needle on a $7.5 billion ship is incredibly difficult, yet Primoris is pulling it off with remarkable agility.
Let's move on to part 3, efficiency and profit margins, the margin reality.
What's really interesting here is the stark contrast in their operations. They run on a razor-thin net profit margin of just 3.36%, which in a lot of industries would be terrifying. However, management is hyper-efficient with the capital they do have, generating an impressive 16.35% return on equity. They don't need wide margins because they operate with intense, high-volume efficiency. They're practically squeezing water from a stone. The underlying data absolutely backs this up. Their return on assets sits at 6.37%, which is a massive 41% jump compared to their 3-year average. Similarly, their return on invested capital is at 10.69%, outperforming historical averages by over 38%. So even with a gross profit margin hovering around 11%, they are extracting way more value out of every single asset and invested dollar right now than they have in years.
Which leads us to the billion-dollar question in part 4. Is the price too high, valuing the growth?
When you stack up the numbers, investors are currently paying a nearly 55% premium for Prime compared to its historical 3-year average. With a price-to-earnings ratio climbing to 33.65, the market has clearly noticed Primoris, and they're charging a pretty hefty entry fee to join the party.
To figure out if that premium price is actually justified, we need to talk about the margin of safety. This is a key valuation metric calculated from the company's estimated future cash flows. It basically tells us the difference between what the market is charging right now and what the raw data suggests the company is actually worth. Think of it as your financial shock absorber.
And right now, the risk profile is pretty stark. The market price, at its last close of almost $169, is significantly higher than the data-driven fair value estimate of roughly $126. That leaves us with a deeply negative margin of safety of minus 34.24%. This single number is screaming that the stock is currently priced well above its underlying fair value estimate based on discounted cash flows. There is practically zero room for error here. If the company stumbles even slightly, the stock price has a long way to fall to reach its actual intrinsic value.
So, is there a safety net? Let's find out in Part 5, Dividends and Financial Health.
First up, how are they returning capital? Well, the dividend yield is tiny, just 0.19%, but their payout ratios are exceptionally low. They are paying out just over 6% of their earnings and barely 5% of their free cash flow. This tells us two things. One, the dividend is incredibly safe and well covered by that huge cash flow. And two, management is actively choosing to reinvest almost all of their cash back into that incredible growth engine rather than just handing it back to shareholders.
Add into that safety, their balance sheet is an absolute fortress. Their debt-to-equity ratio sits at a very healthy 0.28. But what's truly remarkable is that this is down 58.5% from their 3-year historical average. So while they've been growing revenue and exploding their free cash flow, they've simultaneously been aggressively paying down their debt. This shows highly responsible, conservative balance sheet management right in the middle of massive expansion.
And then, just when you think the stock is way too expensive, we hit the ultimate plot twist of this explainer. Despite the high price-to-earnings ratio and that scary negative margin of safety, their PEG ratio, which actually factors in their earnings growth rate, is just 0.66. Now, in the financial world, a PEG ratio under 1.0 is often considered undervalued. This suggests that the intense, relentless growth rate of this company might actually justify paying that premium price.
So, here we are at the end of our financial autopsy, left with the ultimate question. Does this well-oiled, hyper-efficient, debt-reducing cash flow engine justify paying a heavy 55% premium today? Or, with a negative 34% margin of safety, is Primoris due for a harsh reality check in the market? The raw data paints a picture of a truly brilliant company, but it leaves that final valuation judgment entirely up to you. Does explosive growth always beat a hefty price tag? Thanks so much for joining me on this explainer, and as always, keep questioning the numbers.